In this month's Economic Update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Michael Pollock, and this month we're speaking with Chief Economist at SunSuper, Brian Parker. Thanks for joining us today, Brian.
Pleasure to be here, Michael.
Firstly, looking at Australia, with inflation expected to remain well under the RBA's 2 to 3% target band for some time yet, consumer spending remaining soft and commodity prices staying stubbornly low, will another rate cut have that much of an impact on growth?
Look, I think another rate cut will have an impact at the margin, but I think the key phrase there is at the margin. There's a few things about this. One is that clearly it has the potential to put a bit of extra money into the pockets of home borrowers. But again, how they choose to use that is an open question. But the second thing is, how much new borrowing are you really going to stimulate? We already have one of the highest levels of household debt in the world. How much more debt can you really ram down the throats of the average household? Are you really going to encourage a lot of new borrowing from here? My guess is the answer is no. I mean, the other thing is that, you know, if you look at the economy and if you take the view that the domestic economy is looking somewhat sluggish, where's the real area of weakness? It's in business investment, and in particular business investment outside the mining industry. So you've seen the collapse in mining capex, but non-mining capex hasn't really kicked in to take up the slack. Now, the cash rate is only a very, very small influence on that. I mean, how much more investment are you going to generate by another 25 basis point cut in the cash rate? My answer is really not very much.
Great. With real estate prices in Sydney and Melbourne beginning to heat up again, what levers does the RBA have remaining to control mortgage lending?
Well, the short answer is not many. If you worry about excessive lending in property markets, most notably Sydney and Melbourne, then if you think steps need to be taken to address that, that's not really an RBA job at this point, that's really an APRA job. So let's put that to one side. That's really the job of macro-prudential regulation, as it's known. Certainly developments in Sydney, Melbourne property markets do complicate matters for the Reserve Bank, but fundamentally that is an issue for APRA. The other issue though here is twofold. One is venture outside of Sydney and Melbourne and you tend to get a vastly different picture of property markets. That if you go to some of the regional areas of Australia and talk about a property boom or a property bubble, they will look at you as if you're from another planet because they've seen none of it. If anything, some of the regions they've seen exactly the opposite. You've seen prices already, collapse in a blithering heap, and it's been quite painful for a lot of the regions. But the other issue here is that I'm not convinced necessarily that the resurgence we've seen in Sydney, Melbourne prices is going to last. We do have an oversupply problem emerging, especially obviously in the apartment market. I think that is going to weigh on prices. We already have one of the most expensive property markets on the planet. I'm just not sure how long we can really defy gravity here. I think we will see parts of our property market start to correct, despite the fact that interest rates are ridiculously low. But the reality is affordability is just at such extreme levels here that it's difficult to see how you're going to continue to see the kind of property price gains we've seen in Australia in recent years.
What's your view on the timing of another rate cut by the RBA?
I don't think the Reserve Bank is in any great hurry. And the other issue is I don't think another rate cut is really a lay-down misere. There is this view that, interest rate cuts are like cockroaches, i.e. there's never one. Frankly, I think there's a good chance that the Reserve Bank could be one and done here, as they say. If you looked at the national accounts released the other week, it's very difficult to make the case for another rate cut purely based on overall economic growth or even based on unemployment, which has been trending lower. Where you are on more comfortable grounds in arguing for a rate cut is really about the inflation outlook. The Reserve Bank clearly takes the downside of its inflation target very seriously. You've now had headline inflation below target for 6 consecutive quarters. It starts to look a little ridiculous after a while. By their own forecast, it's going to take a lot longer for underlying inflation to head back into the target band, and hence the rate cut you've seen. But I'm not convinced necessarily that the Reserve Bank has made up its mind to do another one. If they do feel the need to do another one, I think they'll at the very least wait for the June quarter inflation numbers. We'll get them towards the end of July, which means the August board meeting is well and truly live. The other issue is wages. And again, wage inflation, despite the fact that we've seen reasonable jobs growth and a lower unemployment rate, wage inflation for the private sector is now sub 2%. That's really very, very anemic. It means that most people out there are getting, barely above inflation in terms of a wage increase. That's not just bad for household spending, because ultimately wages are the fuel for household spending, but it also means that there's a real risk that inflation stays lower for longer than the Reserve Bank is thinking. So while I think, odds favour a rate cut in August, it's certainly not a certainty, and I think the Reserve Bank will also want to be seeing signs about what's happening to wages.
So turning to the US, Brian, with recent weakness in jobs growth, when do you expect the Fed to hike rates?
Look, the weak payrolls result for May clearly does, set things back a little bit. I mean, the people who were pushing for a June rate hike are just going to have to pull back. I think you're not likely to see a rate increase soon in the United States. I think at the very least you want to see next month's payrolls figure. I think you will see a bounce back in that payrolls result. I think that 38,000 gain in payrolls was artificially weak. It does reflect the fact also that the US economy wasn't exactly all that flash in the back half of 2015 and early in 2016, and employment is a lagging indicator. I'm just wondering where the market forecasters maybe didn't fully appreciate just how much of an impact that slowdown in growth would have on the jobs figure. And maybe there was a bit of wishful thinking involved in the market forecasts. I do think you'll see a rebound in jobs growth. You are seeing some stronger numbers in terms of the US economy starting to come through. I don't think the US economy is racing away by any means, but certainly I think you will see better jobs numbers over the coming months, and that is likely to bring the Fed back into the game. I think the Federal Reserve has made it very clear they want to be raising rates. I think they will, but I don't think it'll be at the next meeting. It's more likely to be July, September, something of that ilk.
Which sectors will be the drivers of the US economy throughout 2016?
It's really about the consumer. As long as consumers hang in there, then the US economy will hang in there. It's consumers and to some extent housing. And I think that's a reasonable expectation that you'll see continued growth in consumer demand. I don't think it'll be spectacular, but it'll be reasonable, and it will be enough to underpin US growth. Business investment has been the weak link for some years now. I think you'll see some signs of business investment growth, but I don't see business investment being a major driver. It really does come down to the consumer.
Looking at China, where do you stand on the issue of excess capacity? Is it cause for concern, or is there sufficient demand to absorb it?
Not necessarily. I think it's important not to generalise too much about China. Do we have excess capacity in, let's call it, low value added manufacturing? Yes, we do. Do we have excess capacity in things like steel, for example? Yes, clearly we do. Is there excess capacity in the residential property market? Yes, clearly there is. Is that universal? Is that across all of China? Maybe not. In other words, for every apartment tower that might be vacant, there's maybe other towns and other cities where low to middle income earners need to be housed in a more appropriate modern manner, and so new construction still needs to happen. So I wouldn't want to overstate the problem, but clearly there is excess capacity. And the other, I suppose, dangerous issue is that a lot of the capacity that's built up in the last, say, 5, 6, 7 years has been increasingly funded by credit. And we simply can't be convinced, we simply can't, I think, automatically accept that all that debt build-up has been used for sound and sensible and profitable and productive purposes. I just don't think that's credible. So I think this does pose serious problems for the health of the Chinese economy. I don't think China collapses in a heap, don't get me wrong, but I think clearly China's adjustment to a more services-led economy and to a period of much slower growth than we've been used to, that adjustment is going to be very, very difficult. It's going to be a challenge even for a government that has levers that it can pull that maybe democracies don't have.
So to what extent do you expect the lower Chinese growth targets to weigh on sentiment?
Let's break down the Chinese economy into bits. Let's look at the secondary industry, so manufacturing and construction, and let's look at tertiary industries, i.e. services. If you think, a lot of people have asked, well, is China going to have a hard landing? Well, as far as Australia is concerned, the bits of China that we sell stuff to, they already have had the hard landing. You look at what's happened in manufacturing, you look at what's happened in construction, and you've seen very, very little growth there in nominal terms in recent times. Conditions there are very, very weak. So the hard landing, as far as Australia is concerned, has already happened. But the services side of the economy is still growing at a very, very rapid pace. And that's part of the transition story. So does it mean that overall, does China continue to slow down? Yes, China probably does continue to slow down. Those previous drivers of growth, manufacturing and construction, I don't think they come back as major engines of growth at all in the coming years. It's really about services. And that's normal. That's what you expect an economy in transition to do.
Finally to Europe, Brian. How successful do you expect the ECB's TLTRO2 initiative to be in easing private sector credit conditions and stimulating bank lending?
Well, the short answer is not very. Does it help at the margin? Yes, it helps at the margin. But when you look at the European credit situation, you look at the ECB's own loan officer survey, where they survey the banks and ask them about their lending stance, how willing or otherwise they are to lend money. The evidence from that survey is that banks are perfectly happy to lend money to both businesses and consumers. It's not a supply problem. To me, the problem is a demand problem, is that businesses and consumers in Europe simply don't have the appetite for credit. I think that's the much bigger problem, and the measures the ECB have taken thus far don't really solve that problem. And it means that monetary policy, even the extraordinary monetary policy steps that you've seen in Europe in recent years, it means those steps, while yes, they will have an effect, they're not going to be anywhere near as powerful as, for example, similar measures in the United States.
So what are your expectations overall for the European economy this year?
Look, in short, I think it's more of the same. I just can't see Europe really escaping from the sort of low growth rut that it's in, especially when there's a limit to what monetary policy can do. Monetary policy already has the foot on the accelerator. If you look at, fiscal policy has been a major drag on European growth really since 2010, 2011. Thankfully, in the last year or two, a lot of the excessive austerity measures in Europe kind of came to an end, or at least were put on hold, and hey presto, Europe started to grow again. It just shows if you stop trying to slash and burn your way to prosperity, things actually start to come to life again. As long as fiscal policy doesn't become even more of a drag going forward, or again become a drag, then Europe should continue to post reasonable growth. But I don't think Europe, is going to shoot the lights out in any way, shape, or form. It's a very, very slow growth environment. You could easily argue that growth of maybe 1.5%, maybe that's just potential for Europe. Maybe that's about as good as Europe can expect, given demographics, given excessive public debt and the constraints on fiscal policy. This may be as good as it gets for Europe, sadly.
Thanks very much, Brian.
Pleasure, Michael.